Hey guys, now there's a particular skill that separates great investors from good investors, and that's the ability to understand how psychology impacts investing decisions. You see, in today's world, we have so much access to different information through channels like websites, social media, and YouTube that we're kind of susceptible to making knee-jerk reactions when we fear missing out on the next meme stock or selling investments based on the latest stock market crash videos. Literally, this is a very real problem. I mean, I can't go a day without someone trying to grab my attention with a stock market crash video or communicating about the next big meme stock that's about to shoot to the moon. However, markets are known for being partially driven by fear and greed, and being aware of how to control your emotions can make a huge difference in avoiding bad investment decisions. And on this video, I'm going to share 5 tips which could help you become psychologically a better investor. Number 1, be patient. Now, the saying goes, patience is a virtue, and that's damn true with investing. You see, financial markets frequently move up and down, be it for changes in events like the Wall Street crash of 1929, a reflection of uncertainty like the start of the COVID-19 pandemic, and also change in sentiment like the dot-com bubble at the beginning of 2000. In fact, Robert Shiller from Yale University won a Nobel Prize in 2013, showing how historically stock prices have been more volatile compared to the future earnings and dividends of the underlying companies themselves. The point being, you've got to be able to stomach short-term volatility for long-term gains, and the stock market has shown throughout its history that it usually bounces back from setbacks very quickly. For example, imagine at the start of the COVID-19 pandemic in March 2020, you pulled out all your money. I mean, literally all of it. Now, you'd be kicking yourselves from the amount of gains that you could have made, even in passive investments such as the S&P 500, where the index rose from its lowest point of $2,304 to $3,298 in only 6 months. So a smart tip is to stick to a personal investment plan, such as placing a fixed amount of income each month into investments, and remembering that the tortoise always wins the race and never the hare. Number 2, ignore gossip. Now, there's a saying that goes, buy the rumor and sell the news, which follows the premise that a rumor must be true. However, the problem is in fact that many turn out to be false. For example, a rumor from an insider could be used to prop up the share price of a company, or if it's from a person with secondhand information, they may be misinformed. In fact, there's a story of a famous investor called Bernard Baruch, who for half a century was one of America's most richest and powerful men. Now, one day he had a relative overhear him talking about a company in a phone call, and the relative then thought they'd hit a jackpot and immediately bought shares in the company, thinking that they'd go up based on the information. However, they ended up losing a shed load of money, and after she confronted him, it turned out Bernard was actually discussing betting against the company. The point is, rumors are unreliable, and when you hear them even from popular finance talking heads on CNBC or other mainstream media, the best tip is to ignore them, period. Number 3, invert your investments. Now, at any point in time, investors can be susceptible to undervaluing a stock, and usually this occurs after heavy hype has taken place. This is known as the trough of disillusionment, when investors panic the moment unrealistic expectations are not met, and by no longer investing into a company, the value of the shares plummet. An example of this is Amazon. Now, when the dot-com bubble burst from January 2000 and September 2001, the company's shares lost over 90% of value, and many thought, in fact, that the company would go bust. However, if you were to have bought, say for instance, $1,000 worth of shares at the time at its lowest price, they'd now be worth at the start of 2022 over $386,000. You see, if you're willing to buy stocks when they're cheap and hold until things return back to normal, these can turn out to be great investments. But you've just got to be able to ride the roller coaster of uncertainty for a little while. And this is known as the slope of enlightenment. The key tip here is, don't invest like everyone else. You've got to be willing to go against the market when negative sentiment is at an extreme level. Similarly, this works both ways. When positive sentiment becomes too strong, it usually is time to sell. Number 4, never chase losses. Now, one of the worst mistakes investors can make is doubling down on individual stocks, which are taking an absolute beating. In fact, there's a saying traders live by, which is cut your losses and let your winners run. You see, by investing more into an individual stock that has performed badly, it can cause you to panic, and equally from a risk management point of view, it can lead to an unbalanced portfolio with really too much invested into an individual stock. Now, also, if a share price continues to fall, you have to consider if the fundamental reason why you bought it and invested in the company in the first place has in fact changed. And if so, it's probably a great time to sell. Now, personally, I don't believe that investors should allocate more than, say, 20% of their investment portfolio into individual stocks. And that's only if you're doing good due diligence as well. However, for those that do, the tip here is to know when to accept defeat and move the heck on, because no one wants to flog a dead horse. Number 5, avoid hype. Now, jumping on the bandwagon of popular stocks that have been increasing in value by an enormous amount in a short period of time is exciting. In fact, that's an understatement. It's really exciting, like an adrenaline drug. However, the reality is it's not really investing, it's gambling. Now, when sentiment is sky high and everyone believes that the stock is going to go, for instance, to the moon, the moment the company doesn't meet expectations, everything usually turns sour very quickly. Now, a recent example is Zoom. During the COVID-19 pandemic, the stock went parabolic, rising from $111 per share in March 2020 to $559 a share in October 2021. Now, that's a whopping increase of over 500%. However, all those gains have since been wiped out, with its current price standing at around $112 a share. Now, why has this happened? Simple, because positive sentiment completely shifted to negative the moment the pandemic was in the rearview mirror. The tip is to ignore hype no matter how exciting it may seem, because you may as well go to Las Vegas and play blackjack instead. In summary, to be a great investor, it's important to understand how psychology impacts investing decisions. With so much information available at our fingertips, it's so tempting to make irrational decisions, such as investing in the next meme stock, or for instance, selling investments based on a stock market crash warning video like you've seen. However, by knowing how to control your emotions by being patient, ignoring gossip, really inverting your investments, never chasing losses and avoiding hype, you can avoid making some really bad investment decisions. And if you like what you see, hit the subscribe button and I'll see you on the next video.